Do you think you know what a participating whole life insurance policy is? Well, by the end of this video, I will give you some basic information to help you make an informed decision to consider this type of insurance in your particular wealth and risk management plan. My name is Rick Goldring of the Bay West Group. For the most insightful information on wealth and risk management strategies for business owners, including doctors and dentists, I encourage you to subscribe to the Goldring Financial Leadership channel and hit the icon to be notified of new videos when we upload them. Whole life insurance is a type of coverage that provides you with coverage for all of your life. The base policy has a guaranteed premium, a guaranteed death benefit, as well as guaranteed cash values. The guaranteed premiums can be payable for a lifetime or for sometimes periods shorter than that, depending on the company and the offerings of that company. A participating whole life policy participates in the earnings of the Canadian life insurance company's participating account. Participating accounts with major Canadian life insurance companies are invested in a conservative mix of common and preferred shares, corporate and government bonds, along with some real estate. Now, the account is managed very capably by a very experienced group of investment managers who are mandated to generate consistent and predictable returns for the policyholder. Each year, a dividend is paid out based on the earnings of the participating account, along with the actual claims experience and the expenses. The dividends are not guaranteed, and the dividends can fluctuate both up and down. In years where the returns are particularly good, part of the return is taken and set aside into a reserve fund to help cushion the blow of negative returns. And this way, the dividends can be paid in a very predictable manner. The major Canadian life insurance companies have been paying dividends for a long time, and in some cases, well over 100 years. The guaranteed cash value plus the value of the dividends grow inside the policy tax sheltered. In most cases, the dividends are used to buy more life insurance, often known as paid-up additions. And those paid-up additions generate additional cash value. Now, once a dividend has been declared, it's guaranteed to be there. The only person that can affect that is you if you withdraw the dividends. Now, upon your death, the base amount of coverage and the guaranteed part of the contract, plus the paid-up additions or that extra life insurance purchased every year by the dividends, is payable in a lump sum to your named beneficiaries or your estate, and that's tax-free. The money grows tax-free and is paid out tax-free. The only other financial instruments that are treated this way from a tax point of view are tax-free savings accounts, your principal residence, and lottery winnings. Now, along with paying out the lump sum death benefit tax-free whenever you die, there are benefits to the policy while you are alive. You can access the policy value by way of a policy loan, and you would pay interest on it, and that interest could be tax deductible for investment purposes. Now, I borrowed on my policy on a regular basis and pay it back over time, and typically it's for investment reasons, and the interest does become tax deductible. Now, when you take out a policy loan, in fact, you do incur interest, but your total cash value continues to grow despite the fact that you've borrowed money on the policy. You can assign the policy to a bank for collateral on a loan as well, and you can do the same thing there. There's also other applications that you can use the policy for. You can use the policy for what's known as an insured retirement plan, and I'm going to talk about that in subsequent videos. But you can use the policy with a bank in a series of bank loans to generate tax-free retirement income. But again, more on that in future videos. Now, the best way to learn about whole life is by example. I want to share with you an example of a policy I bought with a major Canadian life insurance company 36 years ago in 1984. So this particular policy is for $100,000, a participating whole life policy that I've had for 36 years. The premium is $1,300 every year. So I have paid, for 36 years, I paid $47,000 worth of premium. Today, after starting out with a $100,000 policy originally, the insurance component to my policy is $250,000 now. And the cash value, if I cashed in the policy, which I won't, but if I did, the cash value is $132,000. So I will continue to pay the premium for as long as I live. And based on the current dividend scale, in 20 more years, I will have paid a total of $73,000 from the original date of the policy 36 years ago from now. So that cash value in 20 more years, based on the current scale of dividends, will be $354,000, and the death benefit $437,000. Now, I can use that for whatever I want. I can use that to augment my income. I can use it to cover off long-term care costs if needed in my long and distant future. Or I can use it as simply as a death benefit to leave to my estate tax-free. Now, participating life insurance is often misunderstood. For most people, whole life is a strong foundational asset. If you'd like to discuss if participating life insurance fits into your overall financial situation and can be part of your wealth and risk management strategy, then I encourage you to click on the link below to arrange a complimentary introductory appointment with me to determine if there's a fit between the services I provide and your particular set of circumstances. Also, if you like the video, please give it a thumbs up and share it with a friend. For the most insightful information on wealth and risk management strategies for business owners, including doctors and dentists, subscribe to the Goldring Financial Leadership channel. Thanks for watching.